Are you ready to revolutionize your relationship with money? Welcome to the Finding Financial Freedom podcast with the Frugal Physician, where Dr. Disha Spath will be your companion on this exciting financial adventure. Get ready to conquer debt, build wealth, and embrace a mindful spending lifestyle that will empower you to live life on your own terms.
Are you looking for alternative investments in tangible assets that help you build and protect your wealth while empowering your financial future? Look no further than Eckard Enterprises. With over 37 years of expertise in the industry, Eckard Enterprises is your trusted partner in the world of alternative investments and asset management. They have a track record of success with more than 1,300 investors on board and over $700 million in capital invested in tangible assets. Their specialty lies in offering immediate cash flow opportunities through mineral rights investments, so that you don't have to wait decades to see your investments pay off. Their unique AML approach, born from decades of experience, focuses on aggregating, maturing, and liquidating assets strategically to maximize returns. Join Eckard Enterprises. Visit eckardenterprises.com today to begin your journey towards building and protecting your financial future. Hello, and welcome to Finding Financial Freedom with the Frugal Physician. I'm your host, Dr. Disha Spath, and in today's episode, we have a special guest joining us. Joining us is Troy W. Eckard, the CEO of Eckard Enterprises, LLC, a family-owned and operated firm specializing in the U.S. oil and gas industry and managing alternative investment portfolios since 1985. Troy's wealth of knowledge and expertise in this industry has empowered private investors to develop successful and diversified portfolios. I'm very excited to talk to him today, so let's get started. Welcome, Troy. How are you today?
Man, I'm fantastic. How are you doing?
Doing great. It's a beautiful fall day here in upstate New York. I'm very excited to talk to you about mineral rights investing today. This is something I know almost nothing about, and I'm very, very excited to learn about it from you. So can you tell us a little bit about yourself and your journey in the U.S. energy industry?
Yeah, I can. In 1985, I was going to college for economics and finance degree, and I was hired by a small investment firm in Dallas to basically try to help capitalize U.S. exploration. And my job was to work with high net worth, high income investors that wanted to directly own oil and gas interest in the U.S., and they got big tax write-offs as a result of participation. And after a couple of years, I decided that I could do it better than the people I worked for. So I started my own investment firm in 1991, and I had that brokerage firm for about 22 years. During that journey, I became very integrated in the oil and gas space, from drilling, exploration, seismic acquisitions, pipelines. And I decided about 15 years ago to put all of my enterprises under Eckard Enterprises, one single entity. It's now a family-owned energy business, and we work on behalf of high net worth investors, high income investors who want to directly own oil and gas wells, mineral rights, pipelines, other oil and gas assets in the U.S. So that's what we do. We represent high net worth investors, and my career has been almost 40 years now in the making. So it's been quite a journey.
Yeah, you've been in the industry a long time. So what exactly are mineral rights, and how do you acquire them? How do they differ from buying land?
When the land grant days were issued back when the country first started, what they decided is they'd give you a legally described parcel of land if you were to settle it. But at the time, no one was really aware of, natural resource from the standpoint of mining or cultivation. So when I bought a 640-acre square mile section of land, when they say, go settle Oklahoma, go settle Louisiana, we give you a square mile, what they did was they divided it between three assets. You get air rights, everything above that square mile not connected to the surface. You get surface rights, everything like your farm, ranch, building that's connected to the surface. And you get everything below the surface in that square mile, which is called natural resources or a mineral right. What's evolved over the last 200 years is that you can now market each one of those as a separate piece of real estate. So you thought you had one piece of real estate, it's actually three. I can keep my ranch, sell off my air rights, or lease them to somebody. I can keep my ranch and sell off my mineral rights below my property, but I don't have to sell it all. I can sell 1 acre, 50 acres, or all 640 acres in that square mile. So it became a marketable asset all over the United States for mining gold, precious metals, oil and gas, any type of natural resource. Really what's occurred is the realization that property owners can now monetize different assets while still retaining the surface rights that they originally acquired.
That's really interesting. So if you own a piece of land and you just happen to have oil underneath it, you could sell off or lease out the mineral rights, and you kind of own the mineral rights just by owning the land.
That is correct. So when I buy a piece of land, unless it's already been declared having been transferred, sold, those mineral rights, that surface rights, and those air rights come to me as the buyer. So I'm in Dallas, Fort Worth. Back in 1997, a long time ago, they started developing the first oil and gas shale play by drilling horizontally and using frac stimulation. Well, it turned out the city of Dallas, Fort Worth was sitting right in the middle of this big shale basin. So you actually have homeowners associations with subdivisions that were created 30, 40 years ago. The guy who developed the property gave them all rights, never retained for his own ownership the mineral rights because he didn't think there was any oil and gas. Through technology, they discovered we're sitting on this huge gas shale basin called the Barnett Shale. When these oil companies came out to drill a well, they said, hey, who owns it? Well, there's 300 homeowners that own 1/5 of an acre. We got to go lease their minerals or buy their minerals. And there's homeowners associations been getting checks for the last 25, 30 years from gas being produced a mile and a half away. So people started to understand, hey, I better start asking, are the mineral rights, do they come with or without the transaction for the surface rights? As you said carefully and eloquently, though, it only matters if you have some kind of natural resource below your property. If you don't have oil and gas or gold or other precious metals or natural resource, it doesn't matter. But now people are very much aware, hey, do I get the mineral rights or not? So that's kind of an evolving thing that's happened over the last 15 to 25 years.
How does your company invest in these mineral rights, and how do you invest for your investors and produce income?
Well, the first thing is that technology has turned what was an obscure part of the industry into something that now becomes a very marketable, realized asset that you and I as private investors can now own. We can go head-to-head, toe-to-toe with Exxon or Chevron or anybody else because of technology and information. So having been on the oil and gas drilling side, participating in drilling wells, I spent 3.5 decades leasing minerals from mineral owners and drilling wells. Well, about 12, 13 years ago, right after the 2008 crash, oil and gas prices jumped to $145 a barrel, and there was a real change in the application of how to drill the wells, how to bring them online, and how to use technology to make them much better. As a result, we went from being this very risky 60% dry hole kind of vertical drilling to now it was 98+% successful wells using horizontal drilling. And the wells are much, much bigger than they were 14, 15 years ago. The consequence of that technology and success meant that no longer was it one rancher on 300 acres where they drilled a vertical well and they got lucky and hit an oil gas deposit. Now you're talking about areas the size of the Grand Canyon. Everybody knows it's there. You can't miss it geologically. Now it's just engineering who can get the most reserves out. So that presented itself with an opportunity for somebody who recognized what was taking place to be able to go in and say, we went from 300 acres to now where I'm at in Oklahoma, there's 40 million acres that has oil and gas. Now I get this huge basin. I'm not going to drill dry holes. Now I just got to figure out which oil company I can go buy minerals underneath that will be the best in class, the best producer, the most wells drilled, the most reserves. So I now use the internet, data sources on the internet, 40 years of exploration expertise to create a model that tells me where to buy, who to buy under, why to buy them, how much reserves. It's a whole strategic plan on how to buy mineral rights. And so my company buys them. We then allow outside qualified partners to participate in what we buy on small portfolios, one portfolio at a time.
So what's the greatest hurdle to investors that they face trying to begin investing in oil and gas?
I'm kind of sarcastic by nature because I've been doing this so long. So I'll tell you, the biggest hurdle is, as I was a speaker last Thursday at the National Association of Royalty Owners, right? And I go, and these are people whose families have had minerals for decades and decades, and they're all oil and gas mineral owners, and no one talks, no one communicates, because most inherently, people are afraid of what they don't know. So investors, they can get online and find out about any publicly traded company and stocks and bonds and traditional public equities. But if you get online and try to find anything about oil and gas, it's obscure, it's scattered, there's no centralized location to find out. So it's the fear of not knowing, it's the fear of not having access to legitimate information. So most investors say, I'm just not going to get into oil and gas because I don't know a thing about it, but I'll buy Exxon stock. That's really because the industry, being obscure, allows for a lot of deceit. So I would say 95 out of 100 people who represent oil and gas investments to private investors are crooks, liars, cheats, and thieves. And they do it because there is no centralized location. So for a 40-year career like I'm moving into, what I look at is the biggest obstacle is having that potential investing partner be willing to listen and learn, understand there's a lot of value in owning oil and gas mineral rights, but you're going to have to be patient enough to learn the process and understand how it works. Otherwise, you're either going to run from it or you're going to get burned by investing with those 95 crooks, liars, cheats, and thieves, right? It's the who factor. Who are you investing with? That's important. The second thing is it's a dynamic industry. So just like real estate, I can buy raw land, I can buy development property, I can build buildings and construction, or I can buy existing cash flowing assets. There's multiple ways to get involved in oil and gas, and the investor has to decide how much risk do I want, how much reward do I want, and then there's layers of where you can enter. I consider mineral rights as the lowest risk asset class in oil and gas. You're the landlord. Exxon, Chevron cannot drill a well on private lands without leasing it from a mineral owner like you and I. So we get the advantage of owning all the oil and gas under our property. Major companies will come in and lease it. They take all the risk, all the liability, all the cost, everything. We take zero risk, and we get somewhere between 12.5% and 25% of all future revenue for free. It's a great position to be in, but you got to buy into the right lease, the right minerals with the right oil company, because oil and gas mineral rights that don't produce are worthless to me.
I guess that's a major risk, right? So you could buy a piece of land that does not produce anything, but you as in the general investor. However, you being an expert in the field, I'm guessing that you know where to invest. Where do you usually invest?
Well, so I break it down even better than that. So the first thing is that we know activation, meaning a well being drilled, is the only way your mineral rights are going to cash flow and increase in value. So the first thing we do is we look at the entire United States. And there's 9 major oil and gas basins. They're like the size of the Grand Canyon buried. And what we've done is we've been investors in probably 5 or 6 of those 9 basins the last 30 years. So I know them very, very well. And we combine low risk in terms of geology and production with state regulations. So I don't want to be in New York because New York doesn't want any fracking or drilling. Doesn't matter how much oil and gas in place, I'm never going to get it out of the ground. I jump across the border to Pennsylvania, massive gas basin called the Marcellus, but it also gets some of the lowest prices and it only has one formation. So I want to have more than one geological reserve. I want to have more. So as I go through this process of delineating what I want to buy in and the reasons between both regulations, oil and gas friendly states, close proximity to the markets like the Gulf of Mexico terminals, we've decided that the 2 basins we want to be in is Oklahoma, and we want to be involved in the West Texas Permian Basin for multiple reasons. Now, when you narrow down that focus, it's kind of like being a doctor. I want to be a specialist as a neurologist or a cardiologist. You take the entire profession and decide what you like and you're good at, and you have your reasons for it. And that's what we've done. We've decided that we want to be in really one of 3 basins, Oklahoma, West Texas, and then I have a ton of assets up in North Dakota in the Williston Basin, and it has to do with economics, location, et cetera. Once you narrow that down, then you can create a financial model that says within that area of interest, what are we looking for? We're looking for this type of oil company, these type of results. And then to further your question about risk, we only buy proved producing minerals. So unless a well's already been drilled, already been proven, already online making money, we don't buy it. We want to have cash flow from day one. And we also want to know an oil company, a major oil company has already proven it successful. And we know they're going to come in and harvest a immature or underdeveloped mineral acre, and they're going to develop with additional wells, additional reservoirs over time. So we minimize the risk by buying proven mineral interest.
So what's the minimum investment to get into your investment?
$10 million per partner is our minimum. I'm kidding you. It's
I was going to say I'm out.
Now, the way we design it, we've been doing this now for 5 years exclusively on minerals. We started focusing in 2018 and 19. We really got busy in 2020. The way we do it is we put together between $5 to $20 million portfolios. They're not like an LLC or a limited partnership. They're just an aggregation of minerals across multiple areas we put into one bundle. And let's say it's a $10 million portfolio. If you put $100,000 in, you'd own 1% of that portfolio. So you own 1% of each one of the mineral tracts. You're not trying to win the winning lottery ticket, right? What we tell our partners is the average partner with our company has about $400,000 invested out of about 24 months of investing. So it's usually $25,000 per portfolio. Some will do more, some will do less. But the key is you're trying to build a portfolio that gives you diversity, gives you minimal risk and immediate cash flow. So the average investment is $25,000 minimum. Most of our clients start with $50,000 or whatever. And then really it's about working with each individual investor. Like, what are you trying to accomplish? What's your goals? How's your tax position? What are you trying to replace? What asset class are you moving away from? And that all develops. So we've done about $630 million in cash paid for minerals since the beginning of 2020. It's an enormous portfolio. I think we'll be right at $1 billion worth of minerals acquired by the end of next year. And we're averaging about 17% cash on cash return. So $630 million as of today, cash flowing 17% across all portfolios. Distributions are made monthly. You get 12 checks and a 1099. It's the most simple investment you'll ever make. There's no cash calls. There's no fees. There's no management fee. There's no exposure to capital calls. You have zero risk. There's no holding costs. You don't pay property tax, but it is a deed and title piece of real estate. So most of my investors are going like, well, why wasn't this around before? I said, because technology made these big shale basins become economically viable. They weren't viable 15 years ago. We couldn't figure out how to make wet concrete produce. Now we can through horizontal drilling and fracking. So it's a dynamic industry. It's probably $1 trillion industry, and it's brand new. It's in its very infancy. We just happen to be lucky enough to have 40 years of experience to say, hey, here's this arbitrage right in front of us. How do we seize the day? And that's what we've done.
Wow. So I heard cash only. So are you not taking on any leverage when you're buying these assets?
Zero. No leverage. The reason why we're having such success is all these other private equity groups and these different energy buyers, they've been using debt and leverage. When oil prices go down, your collateral shrinks, the bank calls your note due. When oil prices go up, well, you're having to go out and pay a much higher price. And today, in inflation rate, you're paying a much higher cost for debt. By being an all-cash buyer, no one controls our destiny. We get to negotiate the best prices. As a seller says, hey, I'm going to sell $20 million worth of minerals. I say, great. We're going to offer you $15 million and we'll pay cash and close in 14 days. Yes or no? Well, that seems ridiculous. Well, go sell it. Oh, you can't sell it. When you come back in 30 days, we still have an offer for $15 million. So we're able to use the power of our partners. We have 1,500 plus high net worth investors today. I get to use our acquisition team to go negotiate like we're sitting on $1 billion in cash. We negotiate those purchase prices down by 25 to 40%. It allows us to sell those for a small fee that we make, which in turn gives everyone a great portfolio at sub-market prices. We do it together with aggregation. We all then split it up according to how much we wanted the pie, and we do it again and again and again and again. And then all we have left is every dollar coming out is cash flow into our pocket because there's no debt. I don't like debt, never will do debt. In oil and gas, it's dangerous. You can be bankrupt in a heartbeat because bankers see oil and gas as one of the most unreliable collateral assets they have because the reserves go up and down as prices go up and down. The Val produces different oil quantities every day. Commodity prices are different. So if you do borrow, let's say you wanted $100 million, they'd say, great, it's a $100 million asset. We'll lend you $30 million. You put up 70 and we want 100% of your cash flow till our 30 million is paid off. I'm like, why would I do that? Well, that's our terms. So I'm not borrowing money from banks or private equity.
Well, that's really heartening to know. And I'm with you on the debt perspective there, especially for something that's as volatile as oil and gas. Oil and gas prices obviously go up and down depending on what the world oil prices are doing and the many, many players in that field. How do you navigate those risks? First of all, you're not taking out any leverage. That's one. Is there any other way we can mitigate that risk?
Yeah. So what we do is we mitigate it for you. So in our financial model, I basically have 4 or 5 directives I gave the team back in 2018. I said, number one, I don't want to lose one dime buying mineral rights. I should never lose money if I'm buying producing minerals. It may have a different rate of return, but I should never buy minerals that I lose money on because of lack of activation or not having oil and gas. Number one rule, preservation of capital. Number two rule, because it's an alternative asset class, I have to have double-digit returns. I've got to have 10% or higher as my minimum rate of return. So you've got to buy and discount that back to a net present value discount at 10% rate of return over 5 years. I got to make 10% a year for 5 years or I'm not buying it. Number three, I only buy under best of class. So whether it's Exxon, Chevron, Oxy, it doesn't matter who the company is. We compare all of them because of the digital access we have of online production and historical records. We then can measure that with our in-house engineers, who is the most efficient oil company, not only at drilling, but pulling oil and gas out quantity-wise because we want efficiency. And then what we do inside of our model to mitigate the risk is that we are hyper conservative. For example, oil prices today are $87 a barrel. Our model's at $70 a barrel. When oil went to $129 last year when Russia started the war, we still use $70 a barrel. So what we've determined is that if we can make 10% or higher return using minimal commodity prices, minimal new wells drilled, suppressing all the density of drilling, suppressing the performance of the wells, which are twice as good as they were 3 years ago. If we keep all that suppressed, we've got enough cushion in our model that, in our opinion, no matter what happens the next 5 years, we're not only going to meet that minimum threshold in economic returns, we're going to far exceed it. So our goal is 10% return. We're averaging 17% across all portfolios. So we believe that because of that suppressed model, we can almost give ourselves internally a certainty that we're going to meet and exceed the expectations of our investing partners.
How do you see the advent of popularity of electric energy and the hyper awareness of, the well-being of the planet playing into your investment class? Do you think this is still going to be a viable strategy 30, 40 years from now?
I think if anything in the last 12 to 18 months, all the data is watching the green energy deal crash. None of it makes economic sense. So if you look at it, forget politics, forget your preference, forget about hugging the trees or running a combustible engine. In pragmatic terms, what you're really dealing with is reality. Reality is the human body, mind, needs the highest amount of energy, the most reliable energy at the cheapest price. And at the end of the day, what's happening is that you're seeing the evolution of all this alternative energy fall apart, because if you put it just strictly in economic sense, in order for wind and solar and other alternative energies to be economically viable as an energy unit compared to oil without subsidies, oil's got to trade at $150 a barrel. So if you took subsidies away, none of those are economically viable, which is why you're seeing so many solar companies going broke, because they've run past their stimulus, right? In reality, if you look at the Energy Information Agency, it shows that fossil fuels are not going to go down. In fact, they're going to increase between now and 2050. The only change you're going to have is that part of the overall energy consumption will include things like solar and wind. So fossil fuel would have gotten 100% of future energy 10, 15 years ago. Now it's going to get 89%. So not only is oil and gas not going to go away, it's actually got the highest level of consumption for the last 4 months in a row. Globally, highest consumption of fossil fuel, even after spending $10 to $15 trillion on green energy, which is fake. So if you look around your room or the back behind me, every single thing in both of our computer screens is made from fossil fuel. So the only thing solar and wind can do is maybe give you some electricity or transportation use, right? But the first person that came out after Russia started the war and oil went up to $129 a barrel, the first person that came out and said, drill, baby, drill, was Elon Musk. And he said that because every part of his car is made from a barrel of oil. Every tire, the dashboard, all the labor, all the cranes are being run by electricity, run by natural gas. And so he said, if I don't get oil down, my cars are not viable. So when I think about fossil fuel, we might have a replacement in electricity or maybe in typical energy for the homes or manufacturing, but you're not going to replace the highways, the plastics, the roads, even the driverless trucks are all run on tires made from oil and gas. So we are going to be a fossil fuel society for 100, 200, 300 years, unless somebody comes up with a tablet they drop into salt water. So if that's the case, one of the things that's most relevant today is we've had such a negative affection for oil and gas the last decade. We've underinvested over $1 trillion to replace declining reserves. So we have record consumption, declining supplies, economics 101, price oil is going straight through the roof. There's nothing we can do to stop it. It should, even without the wars, be at $95 to $110 a barrel over the next 2 to 3 years. And it's going to kill the economy, but that's just where we're at today.
Wow. Yeah, that's really surprising information. Going backwards, you said no capital calls once we put the money in that we're going to invest. Let's go into the costs a little bit more. So how does your company make money?
We buy it for $1 and we sell it for $1.20 or $1.25. We have a fee. My whole goal is, one thing to be clear, 95% of every mineral you ever look at, I've already gone out and acquired. So I take 100% of the risk. I'm probably one of the only sponsors of any asset you'll ever invest in where the sponsor goes out and buys the asset and I own it. So if no investor buys one more mineral acre for me, 20, 30, $40 million of inventory, I carry it all the time, I own it free and clear. So what I do is I go out and I buy those minerals, and my goal is to buy those minerals less than what I have to charge in a fee to run my business and make a profit. When my partners like yourself decide, hey, Troy's got a $10 million portfolio. Hey, I want to put in $500,000 with Troy and own 5% of it. I've already bought it. I own title to it. It's mine. I don't care if you buy or not. I already own it. I get the cash flow. But what we do is we allow you to have all the financial benefits of the minerals that we've acquired. And most of the time, these minerals have 3, 4, 5, 6, 12 months with prior revenue that we get to have with those minerals when we buy them, because the seller hasn't taken the time to get their check, file with the operator. So the point is, we'll buy those minerals, put them in a package, we make our fee, and then going forward, we don't charge a management fee. We give you 10 to 12 distributions and a 1099. The oil companies assume 100% of the liability, environmental liability, drilling liability, capital costs. We're like the king and queen of England. We get a royalty payment, which means we get a percentage of all future gross revenue for every drop of oil and molecule of gas without paying any cost. Why can I do that for free? Well, when Exxon sends me a check for $2 million this month, I can't get my money out without running the ownership deck. So other than stamps, postage, and some accounting time, which we're managing 5,000 wells right now, we have 60,000 plus net acres covering almost 1.5 million acres in Oklahoma. I have to process the check anyway. So we kind of absorb the cost of distribution as part of our overall fee structure, and that allows us to be able to not charge any fees to our partners. Tomorrow, if I decide to retire and, hey, every one of the 5,000 wells and all the minerals, there are third-party companies we could hand it off to, and they're going to charge a fee of, $30,000 or $40,000 a month. Divided by all the minerals and all the investors that we have, it might be $15 a person to get your checks distributed. So there's not a lot of cost because there's no expenses. So we take a gross check in, split it between 20 investors and go, here's your check. It's stamps, it's envelopes, it's time. It's super, super easy. So from that standpoint, I decided one fee, one time, we manage it. We hold title, we manage it for you. You have a purchase sale agreement. You have an exhibit shows you what you own. You don't like my ugly face in 60 days. Say, Troy, I don't like your ugly face. Assign my minerals out. We send notice to the oil companies. Now you get your checks straight from the oil company. The only difference is we manage it for you for free. So we know what to do if the interest isn't right, the revenue checks are delayed. So we do it free because we want you to maximize your return. And quite frankly, we don't want our partners out there selling their minerals at a cheap price because they're in a financial jam. We're trying to protect the integrity of the value by making sure professionals like Eckard manage your minerals for you.
So you're talking about now monthly checks. Let's talk about the tax implications of that. How can investors manage their tax situation when they're getting royalty checks every month?
So think of it this way. The IRS treats mineral rights kind of like residential real estate. The income coming in is 1099 income because you still have the asset, right? They look at mineral rights because it is real estate as it's never going to go to zero. It's just a matter of what your capital basis is. So when we buy the mineral rights, they start kicking off revenue after about 6 months. About 6 months after you write the check, you'll get your first check, and then you get a check every month thereafter. These wells look like they'll last 25 to 75 years. Checks for 25 to 75 years. That's great. So the income is going to be on a 1099 treated as ordinary income. There's not really any tax deductions because you're taking zero risk. And the mineral acre itself never goes to zero. So what a lot of our partners will do is that they'll buy the minerals. They'll combine their income from their medical practice, bankers, lawyers, and say, hey, look, I got $1 million in income. I need some tax deductions, and I'm making $200,000 off your minerals. We then offer participation in drilling, which is 80% deductible the first year. They'll participate in what we call working interest or drilling. Now, we don't have a lot of that because we're mainly focused on minerals. When we do find opportunities to drill, our company will buy a $5 or $10 million package. We keep usually a third to half because I need tax write-offs. We'll then offer to our mineral partners, hey, we got $5 million in drilling. Who needs to participate? We did one last week. It was $4.5 million. It was funded in about 30 seconds because everybody needs tax write-off. And I got to tell you, our participation in drilling has been phenomenal. We're averaging 30 to 40% cash on cash return in our drilling programs. Some projects have paid out in less than 12 months in the last 2 years. So we only buy drilling deals that I like, that I want to put my own money in, and then I allow my partners to participate. So it's kind of a great kind of dual combination. Buy minerals for that stability, working interest for tax write-offs. You combine the two, you kind of have this nice yin and yang kind of approach to participating in energy.
Is there any way investors can buy your mineral rights in a retirement account where they don't have to deal with the taxes?
Yeah, you know what's the best part about that is exactly that. So one thing to keep in mind, if you invest outside of a retirement plan, 15% of your income, you don't pay taxes on. The IRS says, look, you're depleting your reservoir, like depreciating equipment. If you make $1 million in minerals, you only pay tax on $850,000. You can invest in a self-directed IRA, but then you don't get that 15% depletion, right? Because it's inside of an IRA. You can also do a 1031 tax exchange. So a lot of our clients have been selling real estate, rolling that traditional real estate into oil and gas mineral rights, which is real estate, and they're avoiding the 1031 tax on that capital gains. The other thing that's been a big, big thing the last 3 years, one of our partners discovered this, is I can take what I invest with Troy and Eckard. I can go back in and find a third-party appraiser, which we have 4 or 5 independent appraisers. They can take that traditional IRA and roll it into a Roth IRA, and they're getting between 40 and 60% discounts on value. Why is that? Well, according to the IRS and the SEC, they only give value to producing wells, not new wells that'll be drilled or coming online. So we're buying it on market value. The appraiser's marketing on the SEC IRS value. And a lot of our clients will roll $1 million traditional IRA. They'll roll it over to a Roth. And all of a sudden, instead of being $1 million, it's being converted at $400,000 to $500,000. And they're getting a huge tax savings by that discount. And we don't get involved in that because we don't want to muddy the water with the IRS. So we stay out of it, but we say, here's the 5 independent appraisers, go do it. So we've had a lot of clients save millions of dollars in taxes by doing what I just described in the rollover. So yes to IRA, yes to 1031, and yes to the fact there is a major tax savings in that traditional to Roth rollover.
A lot of possibilities there to tax strategize, and sounds like you'd need a good accountant to sort through all of that.
It's really not hard. The actual 1031 custodians will help you with that. The IRA, self-directed IRA custodians are familiar with it. They'll help you with it. These independent appraisers, they know the system. So, we have very busy doctors and lawyers and bankers. They don't have time for it. So they simply find, like Quest is a great custodian. They'll find these appraisers. They'll find a great 1031 expert. And they'll do that type of transaction. It's very, very simple. It allows you to do what you do for a living without having to be slowed down by all these paperwork and intricacies. I always get asked the question, Troy, it sounds too good to be true. So why is somebody selling minerals? Why are you selling minerals? It's simple. It's $1 trillion industry. And these farmers and ranchers have finally figured out, my grandpa doesn't want me to sell my farm, but I got to sell 50 acres out of my 640 acres to pay off the farm, buy a tractor, put my kids in school, put my mother in nursing homes. So it became a marketable asset in the last 15 years. But some of these basins like Oklahoma, it's 40 plus million acres. West Texas is like 100 million acres. So they're using mineral rights to create monetization of their net worth and their portfolio they never had before. So that allowed buyers like me to come into a market that was really not available to now go out and look at millions of acres with tens of thousands of minerals and buy those minerals at the right price because now they can pay off their farms, ranches, et cetera. So it's been a great arbitrage opportunity. I think we can buy minerals for the next 50 years. The difference is today, there's no money in the market. There's no liquidity. We have an incredibly skilled team back here. So we're surgically selecting some of the best minerals at the best prices because we're the only cash buyer. Instead of us looking for minerals 4 years ago, now the phone is ringing off the hook and now I'm drowning in minerals. We're going to do $300 million this year. We are projected to do $84 million. We're at $300 million in about another 2 weeks.
Wow. Because
we're the only buyer left. And investors are flocking to us because they're like, where else can I go buy an investment with no additional exposure, no fees, and make 17% cash on cash with no liability? They're like, okay, why would I not do this? And the other thing I should tell you for your audience, we spent a couple of $1 million and developed our own personal app. It's for your phone and your computer. It's called Eckard Insights. Every one of your listeners can sign into it, say, I'm accredited, not accredited. You get hours and hours of training and video on the oil and gas industry that I created over the last 5 years. But more importantly, is it now makes mineral buying mainstream. I want to check my stocks. I want to check my minerals. We upload all the production, all the tax reports, all the deeds and titles, your revenue every month down to every barrel sold. So now I'm sitting in an airport in France and in Paris and I want to check out my stocks, my minerals. I can pull it up and look and see it's the exact same kind of calibrations you have on your public equities. I did that for one reason. I can't have partners like yourself invest if you don't understand, you can't be educated, and I don't have access to my information. It makes me too nervous. I want to see what I own. So we invested the money the last 3 years to make sure it's the most transparent sector. No one in natural resources has what I've created. No one. To me, it was an investment for the future, and it was necessary because you're not getting money out of me until I can see what I own. I don't trust anybody, really. So I figured most people won't trust me either, right?
Well, that's really great to know that you have that app and you value transparency. I know I've taken up a lot of your time, and this has been such an interesting conversation. I have one last burning question. So what happens when I invest and then I die? What happens to my investment with you?
So keep in mind, it's real estate. No different than in your house or a lot you own. It's whatever your will and estate says. So let's just say something happens to you. Your estate comes back and says, Disha wants to assign it out to her kids or grandkids. It's just a title change for us. So we have all these deeds and titles. Unfortunately, we've had several clients die this year. Heart attack, stroke, had a couple of suicides. Things happen, cancer. So once we get notified that there is a change in ownership or transfer, it's just a document change for us. There's no disruption in revenue because it comes out every month. There's no cost or expenses, so it's fairly easy. The other thing we've done, Disha, is we've created on our app, we're launching it probably in about a week, we call our peer-to-peer market. So without charging any fees, a partner who says, hey, look, I want to buy a house or a lake house or I got cancer or whatever, they can go in and say, hey, look, I want to sell $200,000 of my $1 million portfolio. They'll list it on our marketplace, our peer-to-peer partner-to-partner marketplace. It drags all the data, all the due diligence with that mineral sale. So the new buyer, which is one of our other 1,500 millionaires, they can look at it and say, I got all the data. I got the previous cash flow. Yeah, I'll offer you $250,000 for your $200,000 worth of minerals. You set the price, you set the amount, you have the buying parameters. Then 1,500 sophisticated buyers look at it and say, oh, I would definitely pay $300,000 for that minerals. We've been doing that manually for the last 2 years because of people having to liquidate. I mean, anything that's for sale goes in minutes, but we thought a peer-to-peer would be more fair. And so we invest the time and money to create that marketplace for liquidity. Our philosophy is AML, aggregation, maturation, liquidation. The aggregation is aggregating minerals that are fractionalized, aggregating clients that are fractionalized, bringing them consolidated together. Us all together makes a very, very strong buying force. Then we want to mature the asset over the next 3 to 5 years, letting the wells come online, let the revenue get online, so that maturity creates the value and hopefully lifts what we paid for to a higher value as far as terms of organic growth. And then the liquidation is simply an optional choice. They're your minerals. If I want to sell $10 million of my minerals and you're in them and you say, sounds good, Troy, I'm glad you want to sell, but I like my checks every month, you don't have to sell. But if I do sell, you may say, I want to sell what Troy sells or half of what Troy sells or more than Troy sells. Because they're your minerals, you get to decide. So we've created a system that allows a lot of fluidity between keeping, retaining, selling, doing what we want to do or doing what you want to do. They're your minerals.
Okay, so you get your deed and it's your property and it gets transferred at death just like any other asset. That's good to know. Thank you so much. And I hope that our listeners also found this very informative. If they have any more questions, Troy, where can they reach you?
You can always reach me on 3 different ways. My email is teckard@eckardenterprises.com. You can call my 800 number, which is 800-527-8895, or you can call my cell phone, 469-422-1781. I love what I do. I'm up at 5:30. I go to bed at midnight. I do it every day of the week because I enjoy what I've been doing for 40 years. And I treat my investors as partners. So we use the word partner, not because you're in a partnership, because we want to hear from you what we're doing right and wrong. And we like to sense that we're doing this as an aggregated coupling between our as a sponsor and you as an investor. So we treat you as partners. So I give out my cell phone number. I bet I get 20, 30, 40 text emails a day. I get it 7 days a week. This is what I've been doing since I was 20 years old. I'll be 60 this year. I love what I do. And I have a very close relationship with most of my partners.
Troy, thank you so much. I really appreciate you giving out all your information, including your cell phone numbers.
Thank you for having me. I really appreciate it.
Thank you, Troy, for sharing your invaluable insights and expertise on alternative investments and tangible assets with us today, and for giving us a glimpse into your remarkable career. And to our listeners, thank you for joining us on this episode. If you enjoyed today's discussion, please subscribe, rate, and review our podcast. Stay tuned for more insights on achieving financial freedom. I'm Dr. Disha Spath. Stay frugal, y'all, and we'll see you next time. For more information about alternative investments and asset management, visit EckardEnterprises.com. And remember, Eckard Enterprises is your gateway to tangible assets and lasting financial success. Contact Eckard today.
The content shared on this podcast should not be taken as individualized financial advice. We are here to share our knowledge and experiences, but it is crucial to consult with professionals such as accountants, financial advisors, or attorneys who can provide personalized guidance based on your specific needs.